All right, first time home buyer question of the day. Why should I go FHA loan versus conventional loan? And this sounds like something we talk about every single day, but here's the deal. FHA loans were designed, originally created for first time home buyers. Do you have to be a first time home buyer? Absolutely not. But they were created for first time home buyers because it was supposed to be a little easier to qualify. Now let's talk about what does that mean? Well, number one, your down payment was set a little bit lower at 3.5% down. If you do the math, that's a pretty nice number. The second part of the FHA loan that is nice if you are a first time home buyer is your FICO score can be a little worse. And it can be a little worse and it's a little easier based on that. So your credit could be a little bit, you could have a little bit more debt and you could have a little bit lower of a score. And FHA is designed to likely say, you're good, you're a first time buyer, we'll help you out. So that is it. So you have debt ratio, credit score, lower down payment, and it's supposed to be a little easier qualification process. So if you are a buyer and you have a lot of debt, you have your job is good, but you're not making as much as you'd like, and your debt to income, in other words, your total monthly debt that reports divided by your gross monthly income, if that number is a little high, higher than a conventional loan, then you'll go FHA, no big deal. Here's another thing. If you go FHA just to get into a house, can you refinance into conventional? Absolutely. Why would you flip the loan to conventional? Well, let's talk about that. Number one, with an FHA loan, you're going to have what is called mortgage insurance. Now, I'm not talking about hazard insurance like hail damage insurance or the house burns down insurance. I'm talking about something called mortgage insurance. Mortgage insurance is sort of like a pool of money that's collected every month from all FHA borrowers, in this case, FHA, a pool of money that goes into a pool of money, and that money is used to protect the agency so that they can continue to provide FHA loans for in the case of defaults. So you're basically pitching in on the insurance so that FHA has enough, or HUD, I should say, has enough backing to protect them against a default, because statistically somebody's going to default on the loan. Now, mortgage insurance, FHA, what to keep in mind. It's a two-part process. You're going to have upfront MIP, mortgage insurance premium, which is going to be a percent of the loan amount. 1.75% of your loan amount is charged to you when you use an FHA loan. That's a pretty good number, and you'll see it in Section B of your loan estimate. Good news is you don't have to pay that at closing. That dollar figure is added to your loan amount. So you'll put 3.5% down, but they'll hit you for a 1.75% upfront mortgage insurance premium. And that dollar figure is added to your loan amount, and you are going to pay that over the life of the loan. So it's a big number, but you don't got to come out of pocket with it. Required by law, FHA, HUD rules. The second part of mortgage insurance is you're going to have monthly mortgage insurance. Now, if you put 5% or more down, that number is actually a little bit lower. So sometimes on an FHA loan, we will have a borrower put 5% down if they can, because that'll lower the payment a little bit because of the mortgage insurance. So upfront and monthly MI. You have that on FHA loans no matter how much you put down. So back to the question. If you use FHA to get a home because you're just getting started, that's great. You gain some equity. Why would you want to flip it over to conventional? Well, with a conventional loan, you also have mortgage insurance, not upfront, just monthly. And the monthly mortgage insurance for a conventional loan is based on two things: what your loan to value is, in other words, how much equity you have, but also your credit score. So if you have a high credit score and you have 15% equity, you're going to get a really good rate for that mortgage insurance. So if you have an FHA loan and you refinance to conventional, there's a good chance you're going to lower the mortgage insurance. And the beautiful thing about conventional is that mortgage insurance is going to drop off, and it can drop off with a simple request. So you don't have to, if you are a conventional loan, you don't have to do a refinance to drop the mortgage insurance. If you are an FHA loan and you want to remove that pesky mortgage insurance, you have to refinance the loan. And that is a process. It costs money. So there are pros and cons to both. You can see who would want to use an FHA loan. It's not a bad product. A lot of times FHA loans, we find their rates are a little bit better. So sometimes you can get a better rate with FHA. So FHA versus conventional, that's the breakdown. There are other things we can discuss here. One final little bonus piece I'd like to add to this is on a conventional loan, there's a way for you to actually not have mortgage insurance with less than 20% down. Now, the rule of thumb, as I mentioned, on FHA loans, even if you put 20% down, you still have mortgage insurance. On conventional loans, if you put 20% down, you do not have mortgage insurance. That is very, very nice. It lowers your payment for you. However, what happens if you put 10% down on conventional? Well, normally you'll have mortgage insurance and it'll be based on two things, just as I mentioned, your loan to value and your credit score. But there's a way for you to actually get rid of mortgage insurance without putting 20% down. There's actually something called a single premium. In other words, you can prepay the mortgage insurance off up front, even with 10% down. Now, there's an added cost. In other words, 10%, so you don't have to put 20% down. You can put 10% down and you can pay a premium. Now, the premium is going to be a number. It's going to be, check with your lender, but it could be 3 or 4% of the loan amount. But sometimes what happens is the cost of the premium plus, let's just say 10% down, is a lot less than 20%. So you can technically get into a house with less than 20%, no mortgage insurance. Now, the downside to that is obviously putting a little less money down, you have a little higher loan amount, but your payment is probably going to be less. So it's the more you know, the more you can play around with these numbers. Ask your lender about a single premium mortgage insurance elimination upfront if you're going conventional. That's it for today. I hope this helps. If you have any questions or you want to talk about your loan or you want to strategize, or if you're kind of on the fence between going FHA and maybe you want to see if you can go conventional, give us a call. We're happy, always happy to help. Have a great day.